Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Skyworks Solutions. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest.
All right, Callie. Well, I have a chart of the S&P 500 index. The story hasn't really changed that much. We keep meandering towards new highs. We set a new high yesterday, down a little bit today. We do got the Fed meeting this week, so that's always of interest to the S&P 500 index. Once again, overextended, really dancing between the 20-day and 50-day moving averages as we slowly move higher. What do we see going on in the markets this week?
Well, Brian, stocks are having kind of a rough morning, just like my computer here in my office. By the way, apologies, tech issues on my end. That's why we're a little bit late, but we're here and that's all that matters, right? So we're down a little bit from record highs today after recovering pretty quickly from last week's drop. And like you alluded to, Brian, we're gearing up for a big week that really could set the tone for the next few months in the markets. So what's going on? Well, Brian mentioned the Fed is coming up. The Fed has a policy announcement on Wednesday, followed by Chair Jay Powell's public comments, which are sometimes a little more fireworky than the actual policy announcement. And thinking about the Fed has been front and center in the market spotlight. So it'll be interesting to hear how recent growth concerns and concerns about tapering, frankly, could impact the future of policy. This week is also a big one for earnings. About 170 S&P companies have or are expected to report earnings this week, and they make up more than 50% of the S&P's market cap. And yep, just as you guessed, these also include stocks like Facebook, Apple, Amazon, Alphabet/Google, and Microsoft. And if that's not enough, we've got a hefty slate of economic data in front of us, including the first look at second quarter GDP growth. Of course, that is backward looking, so it may not impact the markets as much, but it could show us just how high of a peak a peak of growth that we're maybe going to be jumping off from the second quarter. And it's also a highly touted economics report, so we're watching it, of course, but it is a little more backward looking. So lots going on this week in what's otherwise been a pretty dull summer for the markets. And it's a lot of new info to digest. And today, markets are having a little bit of an indigestion. It happens. So we're watching this week's headlines closely to see what exactly could be in store for the fall. Earnings reports have been strong, but a lot of people are reading in between the lines this round to get a sense of what company executives are expecting. So far, it seems like companies have been able to pass along rising costs to consumers, and profit margins are holding pretty steady, which is good news for the future. And those were two big questions for us as we moved into this earnings season. And we're going to listen to Jay Powell's comments too. Any mention of tapering, like I said before, could throw markets off balance a little bit, especially after recent worries about growth slowing down, maybe a little bit too much. And, look at economic data. It has slowed a little bit these past few weeks, but it's hard to say to what extent growth could be slowing. And that's why the market's having a few problems with it. We're also watching the 10-year yield as it hovers around 1.2%, which is historically very, very low. It's a pretty ominous level, but you have to remember that bond markets are being whipped around by a number of technical factors too. So they're not always the best proxy for growth these days. By the way, shameless plug, we wrote about that in this week's weekly viewpoint. So definitely check that out. It's a good one. Lindsay and I put our heads together on it. So definitely read about that. Got a lot of good insights in there. So overall, we think there's still a good chance of above average growth, at least through the end of the year, which could support stocks and give the Fed more time to figure out the appropriate policy for this environment. But that may not stop markets from having some indigestion like today, as we transition into this new phase of recovery. All right, Brian, aside from tech issues and bad computers, that's what's on my mind today. So tell us what you're seeing in the VIX.
All right. So if I look at the VIX index, I do have my VIX watch list up. We do see the SPX is down about 1%, NASDAQ down almost 2%. And we also have the Russell 2000 close to just over 1.5%. The VIX index has broken through just actually, as we started this call, broken through that 20% level. And I guess that is the new high volatility mark. That obviously has been an area that a lot of VIX watchers are looking at ever since the pandemic. So we've broken up above that 20% level. We look out at the futures contracts. We look out to September. We're up around 22, 23. October pushing 23.5, and August, which is the nearest term one, is at 21.70 overall. So there is a little bit more uncertainty that's coming into the markets, but a lot of that could have to do just with the Fed meeting. So you always got to, sometimes you can't read too much into it on a week that the Fed is going to be speaking. All right. So overall, more of the same compared to last week. We are up a little bit on the VIX, showing a little bit more uncertainty. Pretty sure it has a lot to do with the Fed. All right. So this week, we're going to kind of get a double banger, if you will, on Skyworks. And that Skyworks is their number one customer is Apple, and Apple's going to be announcing earnings today after the close. And then also Skyworks is going to be announcing earnings on Thursday of this week after the close. So if I look at the chart on Skyworks, we do see a little bit of volatility overall in that we do have a little bit of chop just recently. And you see, this is a very interesting area on the chart. Right around the 193.76 level, right about there. If you can see my crosshairs that I'm showing on my chart. Obviously, there was a breakout and a big fail that just happened back in May as far as Skyworks is concerned. And now we're right back at that level. So interesting enough, we're going to try to use some options to play this around two big earnings, not to mention the fact that Amazon's going to be announcing on Thursday. We got Google announcing this week. So very interesting week to be trading options overall. We chose Skyworks to try to play a little bit off the Apple scenario. And with that said, I'll pass it back to Callie to talk a little bit about Skyworks and Apple in general going into earnings this week.
Yeah, so let's talk about the double banger, as Brian put it. So let's first
lack of a better term. No,
I like
just off the cuff. That wasn't planned. Double banger. I don't know really where that came from, but we'll roll with it.
Hey, I'm impressed. I like it, Brian. And we're going to be talking two companies today, but we are looking at an options trade on Skyworks. So Skyworks, what is Skyworks? Well, Skyworks isn't your typical stock play of the day stock. It is a $31 billion semiconductor company, and that makes it somewhat of a smaller name compared to some other stocks that we talk about. But it's still an S&P 500 stock, and it has a healthy options market below it, so we're going to talk about it. And we're looking at it today because it could be an interesting play here before Apple earnings are released, and they're released after the bell today. So what's the connection between Skyworks and Apple? As Brian alluded to, Skyworks is a major supplier for Apple's products. In fact, I looked it up. Apple's business makes up about 50% of Skyworks' revenue. That's a big, big chunk. So as you could expect, any crucial details we hear about Apple's operating business tonight could also shine a light on Skyworks' operating conditions. And in the past, Skyworks shares have been pretty volatile around Apple's earnings. They don't always move in the same direction. It's not a perfect correlation. And I know Brian has a good chart that he's showing right now on it. So not a perfect correlation, but they tend to move with each other more often than not. I know in the Q3 2020 earnings season, Skyworks shares dropped 2.7% when Apple shares dropped 5.6% after reporting earnings. And then rewind another quarter back, in Q2 2020, Skyworks shares rose 2.4%. The same day, Apple jumped 10.5% after reporting a strong earnings outlook. So it doesn't always work that way, but there's a good chance that something Apple could say could make a difference for Skyworks shares as well. And this time around, this earnings season, We think the FANG stocks, including Apple, could report strong earnings growth and encouraging details about their outlooks. So Skyworks shares could definitely benefit on the back of that. Also, as Brian alluded to, the double banger, Skyworks has its own earnings report coming out on Thursday. Now, expectations are high, like they are for any other company, but Skyworks has a strong history of beating those expectations. In fact, Skyworks hasn't missed an analyst estimate for profits in a quarter since 2010, and at least 2010, because my data doesn't go back before that. So it could be much longer. Of course, investors are thinking ahead. A big theme that we've really hit on for this earnings season is really reading into the details. And they could read into the details in Skyworks' earnings call and in its outlook. And of course, there is risk here. Skyworks, as I kind of alluded to last week with Moderna, Skyworks too is a highly concentrated company. Like I said, a lot of its revenue comes from Apple's operating conditions. So, that could be a major plus, but it could be a major downside as well, depending on what we see today. And semiconductors, Skyworks is a semiconductors company. Skyworks or semiconductors haven't had the easiest summer with the semiconductor shortage, plus the market's hot and cold attitude around growth stocks. But you know what? If you want to speculate on Apple's earnings without following the crowd and you're looking for some potential volatility to play, Skyworks could be looking at it. It could be worth looking at. Plus, I know Brian's seeing some interesting trends in the charts and in Skyworks options, so I want to hear what he's seeing. But before I pass it to Brian, as always, drop your questions in the chat because Brian and I will be answering your questions live at the end of the show today. All right, Brian, tell us what you're seeing.
All right. So if I look at Skyworks, obviously there's going to be some volatility premium in. Just to go along with the fact that it seems like almost every major technology company is announcing earnings this week. And because of that, we're going to have increased implied volatility. So we are definitely going to be doing something where we're buying an option contract and selling an option contract at the same time. One of the things, and if I run back, so that trade is actually going to be a bull call spread. But one of the things that I did want to highlight is that if you look at Skyworks' solution on a valuation point, they trade at about 22 times earnings relative to Apple. That's fairly inexpensive. And if you go back and you look at what the 1 year performance has been, we see that Apple is up from the very beginning of the year. So this is a comparison chart. Apple's up 54%, where Skyworks is up 36%. So we're making this kind of as we saw the chart earlier. We got it. We're at a point of resistance to the upside. Would be very interesting if we could get through earnings and it could push us to new highs in Skyworks. And if that does happen, well, this is kind of a FOMO trade around earnings. It's too risky with all these earnings events to just come on out and buy the underlying stock outright. So we're going to use options to actually partake in this earnings event. And then if you wanted to do something at a later date, feel free to jump on in after the risky earnings reports are done and decide what you wanted to do with the underlying stock. And I think that holds for all the FANG stocks and a lot of the technology stocks that are talking this week. So the strategy is going to be a long call spread. And if we run to the Ally Invest option chains, we're going to stick with the call side. Now, a bonus here is that we're actually down 3.5% on Skyworks going into this big event today. So that's a fairly decent move to the downside, creating a little bit more value. We're highlighting that the earnings are this Thursday. I'm going to scroll down. The calls are on the left-hand side of our chain. We're going to do a very, very short trade. Skyworks is going to be announcing Thursday, so we would get that announcement. I think it's going to be after the close on Thursday. Then you have all day Friday, and then these options are going to expire on the 30th overall. We see Skyworks at 186.02. We're going to try to manage our risk with the spread. We want to give ourselves a little bit more upside than downside, but it's really an all or nothing type trade, obviously, because of all these events. Now, if we have an event today, we might be able to get out tomorrow at a profitable scenario, but if not, maybe after Skyworks earnings, we can have that chance. So you get this opportunity on this 1 week, mainly because of the way that earnings are set up this week. We got Apple first and Skyworks second. So we're buying the 185 strike, and you'll notice here that we're about 86 cents in the money. And then we're going to sell the 190. So the maximum of a long call spread is the width between the strikes. So the maximum it can trade for is going to be $5 here. And if we scroll down, we'll see that we're getting this done for $2.15. That would be our midpoint. Now, I say we're getting it done. That implies that we're guaranteed a fill. Whenever you're doing midpoint fills, trying to get midpoint fills, there's no guarantee of a fill. And as always, I got to put our disclaimer in here. We're just trying to learn here on the stock play of the day. It's not meant to be a recommendation overall. We always want to look at scenarios where an option trade might make sense relative to even buying the stock outright, in that we're going to manage our risk in a risky time period here, right around earnings of all of the technology stocks that are going to happen this week. So I'm going to put this in the right rail. This is going to be the official paper trade. Once I set it in the right rail, that's the way we work here. We're going to be looking to buy one of the July 30 185 strike calls, and at the same time selling one of the July 30 190 strike calls. We're going to call it 215. That's where we're looking at. So I'm going to officially put it in here at 215. That means that our upside in the marketplace, the maximum we could lose is $2.15, or $215 plus commission for every 1-by-1 spread that we do. And then we're going to have $2.85 worth of upside. And I always kind of like to set up my spreads like this around earnings. We're going a little bit in the money. If the stock just stays where it's at, we're going to actually be okay on this trade overall. But if the market goes down, I want to lose more than if the market goes up and I'm correct on I want to lose less than if the market goes up and I'm correct on my forecast. So I like to manage my risk with these spreads, especially if I'm doing the shorter term trade. So overall, we have a lot of implied volatility. So I'm going to scroll down. I'm going to close out the right rail, the trade ticket here at Ally Invest. And I'm just going to show you what the situation is with all the implied volatility that is created or generated because of these earnings reports. If we look at our long call spread, this gray line in the center of our chart is where the underlying stock is at. Right now, the colored line is showing you that if we put this on instantly before Apple's earnings and before their earnings, and the stock ran to 190, we really wouldn't be up as much as if it happens on Friday on that expiration date. On the expiration date, and I'm going to keep my cursor right here and you can read this, as of the target date, which would be the colored line, we'd be up about, I'm just going to round off here, up about $55. But if it happens at expiration, we're up about $270 overall. And that's what the profit and loss graph is showing you. It's showing you that if you do a long call spread, you need time decay. Why? Because you're buying an option that wants the market to go up. That's the most expensive option. That's the option that's going to do all the work for you. But because of all the risk, we're going to sell some option. We're going to sell some time premium. And that option contract wants the market to go down. So the best case scenario here is that time premium erodes and we get closer to expiration. And if I even take this and I'm going to go all the way down to 0 days, all of a sudden you'll start seeing that line morph into that expiration date. This is basically with 1 day remaining to earnings is what we're showing you in the profit and loss graph. So if I'm doing this, I have 2 days for this all to work out. As a matter of fact, if Apple earnings weren't that great, maybe I could just sell and get out of it because there's still some time premium left in these option contracts because of Skyworks earnings that's going to happen on Thursday. So it's a real interesting scenario to talk about Skyworks today overall because they are because Apple is such a big part of their business in general overall. All right, so let's turn to the chat box, Callie. Do we have any questions popping up in there? And make sure you please do put them in the chat box. We're happy. This is a live interactive show. We're using real markets here. So please let us know if you have any questions about this strategy or option trading or just the markets in general.
Yeah, please pick our brains, people. All right, so looking at the chat, William Craig says hi. Hi, William. And we have longtime caller, Wayne. Hey, Wayne. So Wayne has a really good question, and I think it's for you, Brian. Wayne says, hey, I've heard that if out-of-the-money calls are trading higher than equal out-of-the-money puts, that indicates that the market sees more risk to the upside. Can you explain how that comparison works?
Okay. All right, so that's not the situation right here. Most of the what we're talking about here is volatility skew, in that if you have an at the money implied volatility, I guess we can run back and look at the charts. Let's just take a quick peek. Where is my chart? There it is. Okay, so I'm going to go back and we'll use this as an example here. So if we go further out of the money, most of the time, if the at the money vol is at 75 and you go up and you look at out of the money option contracts, and I'll add some other options here. Yeah, and the vol is higher, so we're seeing 76, 77, or a lot higher, let's say like 80, 89, 90, then that usually means that there's a lot of risk to the upside. So where have we seen this recently? It's with a lot of the meme stocks, GameStop, AMC. They had a lot of situations where not only on the put side were you seeing, as you went further out of the money, much higher implied volatilities, but you also saw it on the call side. And when that happens, that basically means the market makers are scared of the tails, of the big out of the money or the big swing in the underlying marketplace. So it doesn't necessarily mean that it's going to happen. It just means that market people are willing to buy those way out of the money option contracts. Market makers don't really want them to buy them, so they pump up implied volatility trying to get them to stop. And most of the time, especially like if you look in SPX option contracts and just something that's a little bit more straightforward, you will usually see higher implied volatilities on the out of the money puts, mainly because more people are worried about a big down move, particularly in an index, as opposed to a big up move. Because usually the velocity to the downside can be a much quicker than the velocity to the upside. And that's the rationale that's behind it. So in this situation, Wayne, overall, indicates that the market sees more risk to the upside. Yeah, I guess that's a correct statement. It does see more risk to the upside, so you're going to have to pay up for it. So that means that if I'm selling you options, I'm nervous, and I'm getting a lot of people that are buying the option contracts. So I'm adjusting my price to fit with the volume that is coming in on those option contracts. So I think in general, I would give a thumbs up to your statement that is basically the case overall. I don't really worry too much about it when it's a 1 or 2% move. But if you look at those meme stocks, there was a large skew, like 10, 15% on the way out of the money call options and the way out of the money put options. Just means that option pricing was crazy in the meme stocks when everything was, and the meme stocks when everything was going on overall. It was an answer. It wasn't, there's no way to answer that one short. It's kind of like that situation. I didn't have time to write you a short answer, so I gave you a long one instead, Wayne.
Yeah, you know what? That was a great answer, Brian. And I'll tell a story too. So way back when I started studying options, I remember the first thing my mentor told me was, chances are if you're looking at a stock, index, options on whatever, the world is net long. The world is net long stocks. So generally you're going to see puts priced higher on a stock because the world buys stocks and they hedge those stock portfolios with options. So, whenever you see calls priced higher than puts, generally there's something funky going on. Maybe there's more upside risk and, maybe there's an opportunity there that you could capitalize on in options. So, that may be a little nostalgic there for sure. All right. I don't see any more questions, Brian. So let's just go ahead and wrap it up. I'll remind everybody too that as always, every Friday, we revisit these trades on Stock Play of the Day Overtime. So tune in. It's at 12 p.m. Eastern right here on the Ally YouTube channel.
All right. And this Tuesday, I think it's the 3rd of August, we will not have a stock play of the day. As you can see, I am traveling at this point in time, so I will actually be on vacation for much of the month of August. But we're going to come back. I'm going to make a commitment to try to come back the following Tuesday, which would be the 10th, and we're going to have a stock play of the day. And going forward for the rest of the month, we will also continue to do the stock play of the day. So please click subscribe, ring the bell, and we will see you Tuesday, August 10th for the next stock play of the day. And please stop in this Friday for the stock play of the day overtime. Thanks for coming, everyone.